Morning, everybody. Welcome to the Flow Show. Morning to all you guys there, Gav, Bran, and me, because it's just me again. So, morning, me as well as everyone else. Hope you're doing well. Hope you survived through the CPI day yesterday. What a choppy day it was as well. Lots to talk about. Lots of moves happening. Lots of things going on, and we'll see if we can unravel it all for you this morning. Right. Going to kick off in Japan. Bank of Japan speculation stirs in Tokyo as traders weigh a July policy tweak. So pumps Bloomberg jumping on the bandwagon to some of this speculation that we may be getting some sort of move from the Bank of Japan in July. Bank of Japan members are still conspicuous with their absence. Zero comments out of those guys for maybe a good part of a week now, which is very strange because usually they're popping up in Parliament, popping up here, popping up there, like everyone else, but still radio silence from those guys over there. So is that an indication something is brewing? Who knows? We did get the top FX diplomat, Kanda, coming out and saying that he's closely watching FX market moves. Fun to be saying that on the other side this time. He did say there is a view that speculative yen short positions are unwinding rapidly. There is also a view that the deflationary norm may be changing in terms of thoughts for Japan. What's interesting about that first comment, or the second comment, that there may be an unwind of speculative positions, yen short positions, that's strange because using the term speculation in their language is something that would have been a step closer, very much closer to intervention when yen pairs were rising. They didn't step into that area of using speculative. So the fact he's using it after the event suggests that they might have been very close to using it before the event or while the event was happening, but kicking in a bit of an open door there by using it afterwards instead of before. So I'm not sure what his intentions were there, but they are watching moves on both sides, as we always know. Coming over to the UK, and there's a house price index called the RICS House Price Index, and the June number was down 46 versus 35 expected. Sorry, minus 35 expected. Oh, what am I doing there? That's not the calendar. There's the calendar. And if it's showing on this one, where is it? There we go, right at the top. Down 46 versus down 34 expected on there, and minus 30 prior. So showing that there's potentially larger impact happening from these rate rises in terms of the housing market. A BOE survey this morning said that UK lenders' expectations for defaults on mortgages rise to the highest since mid-2009. So there is a potential ticking bomb going on at the moment. Over the next few months, there is said to be, and particularly over the turn of the year, there is said to be a huge amount of short-term 2-year fixed price mortgages coming to an end, which are all going to be refinanced obviously at higher rates, and the problem that that may entail. So it's a little bit of a something in the pipe that we may need to look out for down the line. A lot will be made, and a lot is being made, of the pressure on the housing market from higher rates, mostly from the usual press sources fearing doom and gloom. But we have to remember that we are seeing strong wage gains, which will go a long way to offsetting that. Part of the reason why people are pushing for wage gains to combat higher rates and the cost of living. So there may be a bit of an offset that means the doom and gloom isn't as doomy and gloomy as the press expect, which will be what happens usually. So never get too bearish on the UK. the economy and things going on, because it does have the ability to confound those expectations and go against them quite significantly sometimes. But anyway, we shall see what turns out from those. On the data front, we did get monthly GDP numbers, as well as industrial production, construction, blah, blah, blah. Construction was not as hot as expected year on year, 0.2%, down on the month, 0.2%. GDP, I thought this might be a little bit better. It was better than expected, only fell 0.1%. I thought we might get a little gain in that one. So that was the month-on-month GDP year on year. Again, not as bad as expected, down 0.4%. So here we are again, the numbers not conforming to expectations and coming in a little better, or less crappier, should we say. Industrial production, though, that was a bit crappier than expected on the month, down 0.6%. Year on year, coming in and expectations. Manufacturing, though, not as bad as expected, the same year on year. The three-month GDP change, called it a sort of rolling quarterly number, coming in flat versus minus 0.1 expected. Trade balance doing a little worse there as well. So overall, a bit of softness in the UK, pretty much, as I've been saying for a while, what's expected. Not seeing huge, massive drops in activity. We're not seeing any minus 1% GDP numbers or anything like that. It's all, 0 points this, 0 points that, low single digits. So, we could end up in a recession with a couple of quarters of minus 0.1 or something, but that's not going to scream massive economic slump or anything like that. It's more technical recession, just based on those low numbers and anything else. But still, they are coming in better than expected. So that's one small positive to take from that. Over in Europe and the ECB, and ECB's Wojcik said that inflation risks are elevated but more balanced. Don't expect a clear announcement on the terminal rate, as discussions are to continue. We will be ready to tighten policy further or ease it as needed. September meeting is very open, and the slowing down on the pace of rate hikes is certainly a possibility. ECB's Visco says we are not very far from a peak in interest rates, and Stornow says a SEP hike is not a done deal at all, especially with the economy weakening, one of the big doves on the board. Now, coming back to the data, and one thing I wanted to highlight out of yesterday's numbers before we talk about the main numbers is that we saw a big jump up in the NBA 30-year mortgage rate. Rate hikes really kicking off again now. This is the highest since the 9th November week last year. That was at 7.1%, so we're up at 7.07%. The other numbers, there or thereabouts, are small gain applications, small moves in the other smaller components. Keep an eye on the refi index. This is the one that will be affected by higher rates, to see if people are rolling over mortgages. But a big jump up, and this has been jumping up at quite some clips over the last few weeks. So keep an eye on that for the same pressures. We won't see the same pressures in the US regarding mortgages as we will see in the UK, because these are a lot of the mortgages are 30-year fixed rates, if you like. So people who got in a mortgage 5 years ago, 3-4 years ago at a nice low rate, they'll just sit on those, or can sit on those, for the remaining period of their mortgage. It's only really new under that pressure. Right, coming over to the CPI numbers, obviously was the big deal yesterday, and we got lower numbers on both. Headline CPI 3% versus 3.1 expected, so low expected. The big number, the core, that did much better, 4.8 versus 5% expected. So we've lost maybe a bit of stickiness there, quite a significant move lower, 5 pips in that one. Now that's added to the thinking that we've had already in terms of the dollar and yields, and we saw both falling out of bed. The market had its shears out for rate hike expectations, especially for a second hike from the Fed. The market's still thinking we get a July hike, but has all but priced out another hike after that. And as pointed out by my mate in the chat room, Five Magics, even pricing in a cut for mid-2024. That's not so much definitive that everyone's expecting a cut. It's more just the rate moves to do with bringing down these expectations has caused it to look like a cut is being priced in 2024. But we've seen the pivoters try and push for when the Fed might start cutting, and they're probably going to have another go at that if we are now supposedly near a top for US rates. But that effect had a little bit of spillover into the other central banks, with both ECB and BOE peak rates being cut back. For the BOE, traders now see the rate peaking at 6.25% versus 6.5% previously. So a lot of people thinking that, a lot of the market assuming that all these other central banks are going to catch the same cold as the US. Well, as we well know, particularly from the UK numbers, that's not quite ready to happen just yet. The numbers weren't good enough for Fed Barkin, who said inflation is still too high. He spoke literally minutes after the numbers came out. He says demand seems to be settling down, but he's still looking to be convinced that it will feed through to inflation. He's comfortable doing more with policy if incoming data does not confirm inflation will return to target. Fed's Kashkari was out, but these were written comments before the data, so not exactly commenting on the data. But he did say if high inflation persists, Fed may need to raise rates further, so nothing we didn't already know, and the fight against inflation must succeed. The consumer is an area we need to watch, and according to the Adobe Digital Economy Index, consumers spent $6.4 billion on the first day of the Amazon Prime Day event, and that was a 5.96% growth over last year. So the consumer apparently happy to step into sales from Amazon. Well, you can call them sales if you take their dodgy or allegedly dodgy practices into consideration. They put prices up to then knock them down for the sale, and you can often get them cheaper out the sale. But anyway, let's not get sued on this show. But anyway, that was an uplift in spending by consumers on that sale, 5.96%, which shows they are still opening the wallets. Over to the Bank of Canada, and they hiked, as was largely expected, to 5%. And then they really sort of sat on the fence with comments about future policy. They had no more guidance on the rate path in the statement, and they also dropped a prior comment that policy was not restrictive enough. That was in the statement and part of their justification for hiking at the last meeting, but they dropped that out of there. So a little bit of a dovish looking comment or dovish pull of that comment. They did say they saw CPI returning to target 6 months later than they previously expected, so sometime in mid-2025 now. BOC's Macklem said that they are prepared to hike again if needed, but the Governing Council discussed keeping rates unchanged, but decided that the cost of delaying action was larger than the benefit of waiting. The consensus was that monetary policy needed to be more restrictive. They are prepared to raise rates further, but further decisions will be guided by the data and outlook for inflation. He also said, we think we're close to the end of the tightening cycle. A few in the market are now expecting them to go one more hike at their next meeting, and then they'll be done once more and going into pause. Thank you, Simon. No one listening. Yes, well, you're listening, so you better not sue me. Anyway, something else out from a survey from the Fed and their beige book, and they said overall economic activity rose slightly since late May. Employment increase was modest since late May. The labour demand remained healthy in the survey period. Employers reported continued difficulty finding workers. Some districts noted slowing in price growth pace. Overall economic expectations for the coming months generally continue to call for slow growth. Overall price expectations were generally stable or lower over the next several months. So taking from that, still looking like there's strength in the jobs market with that demand remaining healthy, and that there's still a difficulty finding workers. So again, no real signs or signals that we're going to see the jobs market turning anytime soon. Now I've said that, it'll probably fall out of bed next month. Over in geopolitics and the happy clappy US-China mob, they're all meeting now. Blinken is set to meet his counterpart once again, this time at the F.A.C.E meeting, and Commerce Secretary Raimondo is to visit China to meet his counterpart also. I cannot say Raimondo without doing it in a funny voice. Raimondo. Anyway, that's the immaturity in me. That's it I've got from the headlines. Can't ask anyone else because there's no one else here if they've got anything. So if I've missed something, tough luck. You'll have to go and Google it. So let's have a look what's gone on in the prices, because a lot of action going on in the price moves. Looking at the daily for dollar yen, maybe we're going to see a green day. That'll be the first in 6 coming in there. 1, 2, 3, 4, 5. Yeah. So that'll be the first green day of 6 if we manage it. We have dipped into the cloud again. My mate Magic's told me to look out the window, open the curtains and check the weather. And we had made a move down to the cloud. Now we haven't quite got into it. We broke into it. We couldn't close into it. And we're holding above it at the moment. We are mooching around it at the moment. So whether we can hold above it, the main points to the candle, that could be quite significant in trying to build a support picture down here. But coming into the shorter term, and let me get rid of that cloud for now. Oh, no, I won't. That's the one right there. Boom, boom, boom. Where is it? Itchy, 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 itchy. Boom. Let's get rid of that there. So the price action, and I've commented on this in the room, we are currently seeing probably the longest period of not going down anymore than we've seen in any phase throughout this period when we've come off the 144s. This is potentially significant because for the knife catchers, this is the sort of price action I've been banging on about the last few days, in waiting to let the price action try and confirm that we're not going down anymore. Now, doesn't mean we can't go a bit sideways and then collapse through it, not at all. But for now, we've been banging on about this 138 level for months and months, even when we were below it and in that 127, 138 range. This was always the big number to watch, rather than any of these smaller points on the way up. Hence why it's always been a big fat red line for me. So we're holding it for now. Bounces aren't too significant at the moment. So there's a little bit of indecision here. It's pretty easy to trade from here right now. Okay. If we're not going to get through 138, we need to get through 139 and this cluster of lines and tech in here. If we can't get through that, it keeps the pressure on 138 and maybe we break down. So if you're wondering what to do at this point, that is the trades you got to look at. We're either going to go above here or we're going to go above there, below there, or we're going to go sideways in between for a while. But 100 pips means range between these two. 100, 120 pips means that something is going to happen eventually. So if you want to trade it, you don't need to guess. You don't need to think, oh, I think this has fallen 650 pips already, so I'm going to jump in with both feet, put the house on longs. No, we can bounce up to 139 and then collapse right through 138 and off we go for another leg lower. So if you're going to trade this, you've got a bit more conviction for longs off 138 because this price action is telling you we're not quite ready to break it, but you've got to be prepared to take some money off the table on the rallies, lock it in, because if we can't get through 139, then we're not going through 139. So there's no point thinking you're going to get 140 profit if you can't get through here. If you want to short it, this is your area to short it. If we're above 139, 20s, 30s, you're potentially wrong, and we're breaking back up. So you don't want to give shorts a lot of room if you're going to try that one. So a lot to take into account here, but as I said, this is the sort of price action. So it's the longest period we've seen where it hasn't gone down in the whole of this move. That is what you want to look for when trying to pick bottoms in pairs. Now, going back to the wider chart, well, before I do that, again, what I will say, if we are to make a move higher, while some of these levels were not pretty significant on the way down, they're likely to be significant on the way up. So unless we start breaking above probably 141, anywhere below 141 will keep this bearish pressure in play. The rally sellers are probably still going to come running into this, and if they get a decent rally, they're probably going to hit it. Back above 141, they'll get a little bit panicky. Anyone who's been short on this move will start thinking, hang on a minute, we're not getting any bang for our buck anymore. They may turn tail. That's when we get a bigger push up, because they all exit and all the buyers down below get, they start thinking, here we go, we've got a move here, we've got the shorts on the run. So then they start pushing again, and that's when you get a bigger move. But I think rally sellers are going to come in. It's already looking that way because, we're not even getting close to this 139 off these bounces here. So a lot going on. But if we do break this 138, which remains a possibility, the next level I want to highlight is the 50 fib at 137.35. Got a bit of action going on here. We've got the 55 weekly moving average, 137.38, I think it is. I'll just click it there so you can see that. So just coming in there, the brown line, yeah, 137.38. So a bit of confluence there around the fib. Then we've got more confluence down in the low 137s. So I've got an old line here at 137.14. Then we've got the 200 and 100 moving averages at 137.08 and 136.93 respectively. So another bit of decent confluence of text down here. So if we do break 138, might be a quick trip down to that fib and the weekly moving average. If we get through there, then we've got some big action into 137 again, another big figure down there. Then we might play the same game. We find a bit of support down there, it holds up for a bit, we find 138 resistance, then we play the same game again. Will it, won't it? 138 or 137, what's it going to do? But that's if it breaks 138, which we need to wait and see for that. Cable, that's busted through the 130 zone, so we need to have a look a bit wider at what's going on there. We're up through the 61.8 fib, as you can see there, so that's well cleared. We've broken above the big 130. I did 20 pips trying that one last night. I missed, there's a bit of a stinker, I missed the first attempt. I was offered at 129.95, and I always like to hit the first move in when I'm trading big figures like this, and it got to 129.94.6. So I missed on my entry, and then it pulled back, and then I left it alone. And then later in the afternoon, early evening, it was like, right, well, we're not breaking through. Euro dollar's going still, dollar yen's going still, but cable can't get through 130. So I'm going to give it a little short. And I went to bed thinking I'm going to wake up and it's going to be stopped out in the morning. And I woke up and I was stopped out in the morning. So I got that one right, even though I lost money. But we're through 130. The leash is off, perhaps. The next level that the main level that I've got is up in the 131s now. 131.70s, just this other support point that we saw that has been a bit of an on-off. 131.70s probably up to 132s. It was a resistance point, it's been a support point, so it's been an on-off level. So that's my main next level for that for cable is up there. But for now, the move is continuing, the trend is continuing, it's non-stop, even though it's slowed down a bit. It didn't go as fast as euro dollar went yesterday, which was a bit of a surprise. Now, as mentioned, we have had these pullbacks in rate expectations, so that might act as a bit of a break for some of these pairs, and you can see that largely in euro sterling, because we've had a move off the 85 handle. As you can see there, I've been chopping some of my longs up at the 70s. Again, this move is a lot to do with that pace. It was actually the opposite yesterday. Euro dollar was going more than cable. Euro dollar broke into 111s and carried on going, while cable was stuck at 130. So that's partly the main reason why we saw an uplift in euro sterling, just that volatility effect, but for once going the other way. We may get a move back down once that sorts itself out. Cable seems to be playing its own catch-up game this morning. As you can see, 130.70, now going a bit faster than euro dollar. So that means we could get a move back down to the lows down here. For this one, again, on the fundamentals, the ECB is still hiking, the BOE is still hiking. So irrespective of what the Fed's doing, these guys are still hiking away. And until that changes, or until we get something different that changes that rhetoric between the two, I'm not expecting much big change here. I'll just be playing the levels technically, as I have been doing previously. We are getting some breaks around the grounds, though. Look at that, Aussie dollar pretty much did nothing. We had a lot of this noise coming from FOMCs, NFPs, data, ISMs, Aussie data, RBAs, couldn't really do a lot. Again, now the dollar is weakening wholesale. That's given Aussie dollar a push up. It's gone through the 67, it's gone through the 68. It only held there for a proverbial 5 minutes before we got a break. Now we're up to 68.50. So this smells like a bit of a stretch point for this move. It was a prior old level. Just after we broke back below it, we held around there on the bounce after this break, and then it was all down south from there. So I'm not surprised to see it hold up here. I don't know if it's a level I'd actually trade for a short. In the same way, I was warning people not to stand in front of the train when dollar yen was coming down. I'm not prepared to stand in front of the train on this one, just because of the ease of which it's broken what were pretty solid levels. We were talking about this 67, talking about the 68, and the speed and ease which it's gone through means I'm cautious with what to do on this one on the way up. Is it a dip buy? I don't know. I'm not too sure. I'm not too keen about the whole of the move at the moment. So I'm not looking to do anything particularly in this. If maybe you see 68 tested and holding, that will give you a bit of conviction if you wanted to try longs. But for shorts, if you're going to be trying it up here, you've got to keep your stops pretty tight, because if you break, like we've seen here, you're likely to break quite significantly. So, you don't want to be sticking 50, 60 pip stops in, 10, 15, 20, 25 pip stops at max. If you're going to try fighting the trends, that's the most risk you want to be doing on pairs like this. What's been going on elsewhere? Well, yields obviously still suffering. Looking at 10 years, well back in the box now. Back below 3.9%. That was an important level on the way up. We didn't do much at it in this time, but we are now. We're back below. So we're going to play the same game again. We're going to be looking at the 3.7 area. to see if that's where the market wants to finish with this downward move. If we get under there, then we've got a bit of line in the sand, I'd call it 3.6. This 3.6, 3.9 range that's happened for the last month is what we need to look at. If the market really does start getting dovish about the Fed, we're going to see yields coming down much lower. We can't rule out, obviously, the market does it time and time again, running from one side of the boat to the other, getting far too extremely dovish over this CPI numbers. If we start to see that, the Fed are going to push back. We've got to remember what's changed even after the CPI. The CPI has gone the way they want it to go, so the Fed are winning. They've got soft landing conditions, mostly strong jobs, sectors like services doing well, CPI coming down. It all means soft landings, which isn't a bad thing. It doesn't mean they're going to be cutting rates in the next 5 minutes. Quite the opposite. If the economy continues to heat up, then that's going to keep them keeping rates higher for longer, because if the economy hots up, that'll bring with it inflation anyway. Then they're on the wrong side of the trade again. So that's the only big risk in why rates might go higher again, and why they might not pivot to cutting rates, is if the economy heats up, even while inflation is coming down, because there'll be a lagging effect in there. Rate hikes are there to cool economies if they get too hot. So for yields, as I say, watch for a potential running too far to the other side of the boat. Like if we get below 3.7, 3.6 in yields, to me that will scream we've gone too far. The dollar's likely to have weakened significantly on the back of that. That's when I'll be thinking, no, I'm had enough of this. I'm going to start looking at trading it the other way. That is going to continue to fall into my thoughts for cable and trying to judge when things go right for the BOE and when they peak out on rates. But for now, speaking about cable again, it's got room to gain significantly. You know, it can be at 133s before it decides to turn, such as its nature. Dollar CAD, that's on the fritz again, even after the Bank of Canada. Again, this is more from what's happening in the dollar than what's happening in the loonie, even though some of the market are expecting another hike. They're expecting one and done. 130.80 is still my level down here. We've already seen the big figure protected in that previous move in June down into the low 131s. But I'm going to watch this level with judging the move, what happens. If it's wholesale dollar selling, if we're seeing legs lower again in dollar yen and then higher in other pairs like cable and euro, I'm not going to have as much conviction in trading that level. And if I do, again, it'll be a tight one. I won't give it much room. Maybe stop below 60. Because if it's through 80, through 60, then the trade is wrong. So, you know, technically it looks a good level, but we'll see what the price action says about that one. Dollar MEX I'm going to look at because I absolutely balls this one up yesterday. For those that may not know, I was long, similar to Blake, down here. Again, as I was explaining yesterday, when trying to pick lows and pick bottoms in dollar yen, this is the sort of price action you want to see, where the price has stopped falling for a period of time. But I had a stop in at 16.95 right in there, and I also had reverses in, sell stops in to turn the long into a short. But in my wisdom, I decided that I didn't want to have the potential to get flipped out over the data, i.e. my stop gets triggered, the short gets triggered, we have a quick flash down to, you know, 16.92s or something, and then a quick reverse back up, you know, an instantaneous thing, you know, 30 seconds, I'm stopped both sides, and the price has gone up again. So I pulled my stops on the long, and I pulled my sell stops as well, and I went manual. And when we got down here, we were knocking around 16.94 after the data. We'd had some period, we got that bounce up here. I was like, right, no, I think we're broken, so I'm going to stop myself out of the longs. And I didn't put on the shorts, and that proved to be a wrong decision because we went all the way down there 1680. So I would have made my money back on the long stop and some on top as well. So I completely ballsed that one up. Well, I say completely ballsed it up. I made the decision to pull my stops for what I thought was a valid reason at the time, just to try and protect myself getting flipped out. So I'm not going to complain too much, but such is life with trading. You can't get them all right, and you got to do what you feel is right at the time. Can't trade backwards. It looks simple, what I could have done, but I didn't. Could have, should have. I did what I did, and I have to live with those consequences, as we all must. So you can have no regrets with what you do with trading. You can only decide what happens in the moment. Dollar China had a little break of this area down here, and I think the market is still undecided what it wants to do. This was an area I was potentially looking at for a long, but I left it after all that data yesterday. Now I'm not too convinced about it at the moment. We definitely seem to be trending lower now. Still haven't quite broken the trend though, because we've still got a long way before we even tap the 38.2 fib of the wider move here. But short term, and particularly if you just maybe take the secondary leg from here, we are pulling back a bit. I'm not quite ready to get back into longs. This is going the way that Chinese authorities want it to go. I'm not quite prepared to fight that just yet. Maybe if we see the dollar stabilizing in pairs like dollar yen, I might think about getting back on the train. If I do look at it, my next level is not going to be down until the 711, 712s, which was an area that I got in on the second leg higher up. So I've got a lot of caution today with trading. Got a lot of caution. We've had some big moves. We've had some big data. Levels are broken, like Aussie dollar levels that struggled to break over NFP's data and all the rest. We've now broken it over CPI. So what I tend to do is moments like this is just let the market settle down a bit, let the levels develop, show where the supports and resistance want to come in. We've got some early indications like dollar yen at 138, but it needs further development before I go piling into trades and thinking here are some more tops or bottoms. Guppy, I know a lot of you guys trade, and this one held up pretty well. It got below the 180. A lot of people had the 180 there. Just tagged the 38.2 fib of this particular leg, but couldn't hold below it. We're back above, so we're holding the body of the candles above this fib at the moment, which again gives you a bit of an indication, a bit of a signal that there might be a bit of a bottom in play. As you can see there, 1, 2, 3 goes through the fib and just into that 179.39 area. So that again gives you a bit of conviction that, okay, we're not going any lower right now. We're not doing what we've done here, low, lower, low, lower, low. So that gives you a bit of confidence. And obviously we got the pound influence with cable giving this one a bit of a jolt up as well. So whether this one goes all the way back up remains to be seen, but it's going to need to do a bit of work. Got to get above 182 at the very least to undo a lot of this move down here. I know Gavin, you're looking at this one quite often as well. So if you want to chuck something into the comments, then please do regarding that one. Yeah, let's have a look at euro dollar. It's coming to a bit of a wide one. Let's have a look at that one. So breaking up above, you can call it a channel, I suppose. You can call it a wedge, whatever you want to call it. It's a resistance trend line. We're back above that and give or take finding support against it. We have the underside of a bigger line coming up here as well. Let's take that out quite far. So this is a big, huge line. going all the way back to the 2000s. We had the breakthrough last year. This might be the first test of it. And as you can see, poking in there, if I can zoom it in, we've also got the 200 weekly MA in there at 1184. So that's marking a bit of a top at the moment for the pair. The high has got to 74. These sort of larger MAs, when you're looking at weekly, monthly, things like that, they're important to look at more from a closing basis rather than a touch basis. You can trade them on touches, but it's where you close. If you continue to close below big moving averages like that, you can't really see it. It's just in there. That is more of an indication for moves and trends, like we've got down here against the 100 weekly. You know, this was my blue zone, but look, we got the 100 weekly moving average right in there as well. So it's where you close on these things that matter. So if we close below it this week, then it might give shorts a bit of ammo to try getting in up at these highs and against it and against that trend line. So again, bit of confluence coming in up here. 112 is also a big level. As you can see, coming in across there. Previous support, previous resistance, one of those big long-term levels that hasn't sustained things going back quite some distance. So a big level. I know this one's on Dale's radar, and he may well get it today, depending on what happens later. But
hello, mate.
Oh, look who's here.
I've just arrived at the hotel.
Oh, you're at the hotel now. What are you doing here? You're on holiday. You're supposed to be on holiday.
It's okay. It's okay. The wife's out to the supermarket, so I'm staying with the kids here. Anyway, how are you doing? How's everything?
Yeah, all good, mate. All good. Fun and games in markets.
Oh man, yesterday was a move and a half, wasn't it?
Yeah.
And I'm sure you've talked about it. We have PPI today, which could either make markets continue on this move, which I think is again the most likely excuse me scenario, or it could throw a spanner in the works. If we see PPI stronger than expected, then that will complicate things. But I'm sure you talked about it. The main thing for me is 10-year US 382. Yeah. I tweeted about it and I put it in the chat room. I said below 382, it's a false breakout, and we are at 382. So a big decision to be made here. But
we just literally talked about it about 2 charts ago, and we were saying, we're back in this box under 390. We got this 370, 360s to play with. It's I was just saying we've got the possibility now. The markets hasn't turned dovish, but it's turned much less hawkish. There are parts of the market priced in a cut in mid-2024 already. If this goes too far to the other extreme side, i.e. too dovish, that's going to present opportunities, I think, to start countering some of these moves. Because we know the market always runs too far the other way, and it might just do this on that. But a good point. I'll just finish up on this euro dollar, and then I was going to look at the PPI. Holding above this trend line for now. So you've got your places, you've got your resistance up into that weekly MA, the trend line, and factor in that 112. Again, this might be a big figure that I look to tap a short as well. I'll see if I can get in ahead of Dale. I can front run him. I'll park up wherever he's offered. I'll park up a pip in front of him. But yeah, that would be my ideal place to try a short. But it would need to. We've got a lot of work to get back down again now. So I'm expecting 110 to become an even more solid level now. And I would expect 111 to start building some support as well. If we get back under 111, if we close the week under 111, then I think we've had a little bit of a blow off the top, and then we're potentially going to be back in the range. But we might just start to set a bit of a higher range, just like down here when we had the 107s, 108s, then we stepped up 108s, 110s. We might be heading for another step up, maybe 110, 112 for a bit of sideways range. But I can't see this pushing on much further through 112 unless the market does get too extreme, dovish on the Fed. But if we do, just to highlight quickly, we have an absolute monster level above there, up at 115. This is pretty much 138 in dollar yen. This 115, it's a absolute massive level that goes back years and years and years and years. Talking all the way back to well, obviously not real 1979. That's extrapolated, but you can see it's a big level up at 115, 114. A level I've traded quite often actually, because it can be a bit like, as I say, the 138 or 145 in dollar yen. So should we get above that 112, just have that 114.5 to 115 level at the back of your mind, because that will be a real doozy. Right, let's have a quick look at PPI, and then I will have a look at EuroCAD Gav. So yeah, we've got this PPI data today. Now, if we'd had hot CPI numbers yesterday, I think this would have made a bit more of a difference today, because it would. I think it's likely that it's going to come in softer. Those numbers right? I thought we were looking for negative numbers. Give me 1 second.
No, I don't think we're looking for negative, were we?
No, we're not. No, we're not. But what I think we'd be getting is further softness. So this month PPI is expected to rise month on month. It fell 0.3% price, expected to come up 0.2%. So if it does come in hotter, the market's leaning that way already. And 0.4 year on year is still, a pretty low number. It's still down on the 1.1% previously. Now we do have some core numbers as well. We've got ex-food and energy up here, so that's expected to drop 2 pips to 2.6%. So the risk here is that we do see hotter numbers, and then that's going to take some of that CPI move out of the market. But I'm not sure it's going to, completely 180 what we've just seen. The market is expecting PPI to stay a bit stickier. I think conversely, if we see softer than expected numbers, it's going to be a bit of a confirmation for that CPI yesterday. We may get another test of the lows in something like dollar yen. I would be surprised if it breaks on that, but it could be a good opportunity if you want to try and catch the knife and haven't already. If you get a move to 138 in dollar yen, that might be a bit of a gift if these numbers bring it. But I wouldn't expect it to break unless they were really shocking numbers, like down 5% or something like that. But even then, PPI is a bit more volatile than CPI, so sometimes it won't get traded as hard as CPI.
Ryan, do me a favor. Sorry to interrupt. Do me a favor. Click on the PPI year-on-year header, and that will show you the chart. That one, yeah, that will show you the chart. It's really interesting because look at the shape of it. You scroll down.
Yeah.
It's it's come up and it's coming down. It's very symmetrical. It's actually very similar to CPI, and I just want to make a very clear distinction. What we are seeing here is not a return to normality. What we're seeing here is high prices baked in and staying high because we had a shock, right? So we had the aftermath of COVID, and then we had Ukraine, which shot basically prices higher, pretty much everything, right? All agricultural and anything that's influenced in any way by Russia and the Ukraine shot up. And unfortunately, it's the big majority of commodities. So you have this shock, and you see when you have a shock, and this is a year-on-year number. This shock slowly comes into the year-on-year calculation because you have a 1 year of data, then you have a shock, and that's 1/12 of the calculation. Then as you move forward, it becomes the next month is also the price is high, and you're adding high rate months. So this is why you're seeing the trip up to 10%, and now prices remain high, but the rate of change of these prices has not increased. That's why you're seeing now rate of change of prices being low, replacing months where the rate of change was high. And that's why we're going back to 0% or close to that. Does that mean we're all good back to normal? Of course not. Everything is more expensive still. It's just that the change of that is not increasing, as it used to.
Yeah.
And this is the same with CPI. Everybody's saying, oh, we're 3%, we're going to go maybe back to 2%. All great. No, it's not. We need to be seeing negative PPI, negative CPI, without the fear of deflation. Seeing negative CPI prints from the aftermath of what we saw the past 2 years would be a really, really good thing. And it shouldn't be confused with, deflationary spiral. We could never have a deflationary spiral if we are running all these massive deficits every year. The US, the UK, Japan, and everything. Sorry, just to clarify, the chart looks really good. We're going up, we come back down, back to normal. No, it's not back to normal. It's just that the rate of change has stopped.
Yeah. This isn't a price. This isn't like the price of a loaf of bread or
exactly.
a spare wheel. This is the rate of change. So this is how prices have changed since last year. So if they come back to zero, it just means prices haven't gone up. But if they went up 10% last year, we're still 10% higher, even if PPI is at zero. Doesn't change the price of things. It's only if you start seeing negative PPI, then that indicates that prices are starting to come down. And that's sort of my point with the PPI. We're seeing it globally now, where PPIs are turning negative on the month, on the year, particularly in Europe. We're seeing those negative numbers. That will feed into, at the moment, if we get a positive moment, if we get a positive, continue to get positive PPI numbers in the US, all it does is suggest that CPI is going to remain stickier a bit longer. If we get negative PPI today, that will just add to what we've seen in the CPI. The market will say, right, well, CPI is going to continue lower. But as I say, trading wise, PPI can be a funny one. I would be surprised if it takes us to new lows and new highs on this number. Obviously, depending on where we sit at the moment, cable's sitting 12, 20 pips off its high, so it's doable. But for other pairs, like I say, dollar yen trading 138.60, 58.60, 60 pips. If we're there and the PPI gets you down to 138, that might be a good opportunity to try a trade down there. Lost you for a minute. Euro CAD, again, I want to look at, and this is one I was looking at for the BOC. Now, quite interesting. We were knocking around just below it, so I wasn't confident in trading it over the BOC. If I've got a big level, I don't want it 20 pips away over a big event when it can get whacked around. And it took a knock up above. We are, give or take, holding it as support at the moment. We've had a bit of a break. It pushed through by 6-7 pips, 52s, 53s. That's where the market wants to park at the moment. We've had a bit of support into there now. So this one, again, I think it's going to be important what happens on a closing basis. Now we've broken above, if it's going to have some legs to challenge that high, which is quite a way away, it's got a bit of room to do so. There's not too many levels in. 148s is probably a level you could, I could probably stick a line in there as one to look for. Again, I'm not, even with this break, I'm not confident about it. So if I was going to trade a hold of this line here, I'd keep it very tight, below 30, 46.30, something like that. You're likely wrong. And if it does pull back below, then we're going to go back into this range. I'm going to do it again. You guys, you can tell me this. Do you think we might be sitting up for a little bit of a head and shoulders in here? Maybe build a bit of a shoulder up here. I don't know. That's two charts I'm looking at, head and shoulders. I can't believe it. How is that other one doing? Still, did you get in, Stel? I know you were looking to jump in a short on the old Euro knock, or were you packing your cases instead?
Yeah, I missed everything because I was out yesterday and I was packing before, and I missed everything. So unfortunately, I did not get in. But hey, it's playing out.
Yeah, the way of life, mate. We both got knocked out at the top here. And you know, as I said earlier, no regrets, no regrets. You can't trade backwards. But anyway, the next level is approaching 1120s. Bit of a level ahead of the fib. So if you're going to find anywhere to catch a knife, you know, as I said, pick your battlegrounds. Look for the decent levels. This looks like one at 1120. Looks like another one around 1114 and that fib area. So if it's going to put up somewhere, that's the area you're going to look at. The break of this line is going to become a potential resistance point. If we get a test up there, how that performs. If you find it's holding under, it's going to keep you on the short side, going to keep the sellers in the game, then for a potentially bigger push down. So again, nice and easy trading. 2 areas to look at, one on the downside or 2 on the downside, 1 on the upside. You trade them accordingly. No need to guess, no need to overthink it. So you're going to hold it or it's going to break it, and how you trade it is down to you. Right, anything else, boys and girls? I've been waffling on again. I can't hand it over to the charts unless Stell's got the charts on his phone. So what's your plans for the holiday, mate? You just parked up in a hotel, or you doing a bit of travelling?
We are going to be at the hotel for the next 2 days. Then some friends come. We've rented a villa, so that's going to be nice. And then we go back home. So we're going to be mostly around the swimming pool and then going to the beach every day. So really, really bad situation.
Yeah, well, I don't want you coming on the show. You should be enjoying your holiday. And
no. Whenever I can, I'm here. You know,
just now lots of ice creams and
yes,
billets of Blake. Right. Well, we'll call that a day for today. Lots to look at, lots for you to get your teeth into and trade. And I hope we've set you up well enough to look at the levels, look at how you're going to trade things. More data this afternoon. So like yesterday, stay safe. Still enjoy your holiday. And we shall see you all tomorrow on Friday. Thank you very much, everyone.
Cheers, Ryan. Thank you, everybody.
Cheers, mate.